welcome to another edition of the Capital Record podcast. I'm your host, David Bahnsen of the Bahnsen Group, and I am very pleased to be the host of Capital Record, brought to you by National Review's Capital Matters each and every week. And today I'm going to be bringing on Peter Boockvar, who is the Chief Investment Officer of the Bleakley Financial Group. You may recognize him. He's a very regular contributor at CNBC. I've appeared on television with Peter before. We've spoken at some of the same conferences, but I know Peter more from his research that he publishes, the Book Report. It's subscription driven. I've obviously had a lot of my research providers on Capital Record already. And there is a lot I benefit from in Peter's research. He is a very quick, early morning, responsive kind of analyst and economist, and that's exactly the type of thing I like. So the reason I want to have Peter on here today is to continue in this discussion about inflation. And we've had the viewpoint of economist Lacey Hunt. We've had Jason Trenert. I've discussed this with John Malden. There's been a number of conversations about this issue as to where exactly things are headed, given the current both fiscal and monetary policy regimes. Peter is right now an outspoken prophet against inflationary pressures. He believes that disruptions in the supply chain, coupled with newfound fiscal and monetary policy activities, are putting on inflationary pressures that he's very concerned about. And I want to talk to him today about the parts I agree with, the parts I disagree with, and just kind of unpack what the heart of the matter really is and see if we can't have a fruitful conversation. So let me bring on Peter Boockvar. So with that said, let me welcome our latest guest to the Capital Record, Peter Boockvar. Peter, thank you for joining us.
Thanks so much for having me. I appreciate it.
Peter, I assume quite a few of our listeners, and hopefully after this even more, am a regular subscriber. I read, I would say, your daily contributions to my inbox, but it actually is probably, what would you say, 3 or 4 contributions a day to the inbox, at least 2 or 3. Really valuable stuff. I appreciate the way that you can give snippets of economic data almost in real time. There's times where I'm getting it off the Bloomberg screen, and I know you are. And by the time I've done reading it, you've already done your commentary, analysis, and elaboration for your subscribers. And one of the themes that I really wanted to unpack with you is a theme that you've been writing about as much as anybody in the last few months anyways, and that is the subject of inflation, particularly in light of the several bouts of stimulus that were passed out of Congress, and then, of course, the ongoing Federal Reserve accommodations. And so you and I were both speakers at the recent Malden conference, and much like his conference here on Capital Record, we've had people on both sides of that issue. And I think most people come from a similar worldview, somewhat sound money oriented, free enterprise oriented, low regulation oriented, critical of the Fed in a lot of cases, and yet some pretty different conclusions around inflation, deflation. And so I'd love for you to just maybe start off by giving us your thesis as to why you think we're in for a maybe more sustained inflationary period.
Well, I like to look under the hood when we're talking about inflation and distill the difference between services inflation and goods inflation, because I think it's important to create that distinction for people to better understand where the inflation pressures are, where they've been, where they've not been, to see how it's all coming together. Historically, services inflation is never temporary. It's always upwards, with just really the rate of change that is the question. And we know a lot of that is the cost of housing that's captured within CPI and the PCE metric that the Fed likes to focus on, and that is rents, which also tries to capture housing generally, but imputed rents is what the calculation is. And then you throw in the cost of health insurance and just general insurance, whether it's auto insurance, life insurance, tuition, and really think anything else really in services. I mean, if you send your kid to day camp, you're probably paying 3, 4, 5% higher than you paid the year before. It just seems that everything in the services sector goes up. And in fact, pre-COVID, if you look at the 5-year and the 20-year time frame pre-COVID, services inflation ex energy within CPI averaged an annualized gain of 2.8%. But on the good side, because of technology, production efficiency, and just the ability, particularly the technology sector, to make better and greater products for less, plus you throw in some sleights of hand by the Bureau of Labor Statistics in terms of how they hedonically adjust certain goods, that the 5-year and the 20-year time frame leading into COVID, goods inflation, ex food and energy, have basically averaged 0. So you combine the two, you have something in the middle where about 60% is the services side, but the good side's been a drag. I think now what we're seeing is, after a temporary reduction in the rate of gain in services last year because of COVID and into this year, obviously with people stuck at home, services inflation is now reaccelerating. I think you're going to start to see some surprises on the housing component in particular, to reflecting much higher rental increases. And now you have goods inflation. And you have goods inflation that's running at the fastest pace in a while because of high raw materials, shortages of products, and very aggressive and sharp increases in the cost of transportation, which is a service, but everything that's produced ends up on a truck, a ship, a plane, or by sea. And those prices have skyrocketed. So yeah, that's services inflation that's now embedding itself into the goods side. So really, when you discuss and you debate inflationary, temporary or not, it's really a debate about where goods prices are going to go. Because as I stated, services inflation is never temporary. It's always rather persistent. So what started to get my attention was rewind the clock a year or more, when you started to see shortages of stuff at the supermarket, when you obviously had this rush of demand for food as people were just eating at home, and the supply chain could not catch up. Now, that's because of a variety of reasons. Obviously, the labor was a key part of that, because people weren't showing up to work, or there was COVID outbreaks and so on. But that was the first sort of indicator that COVID's creating some major supply side disruptions. And then you fast forward the clock past, the Pfizer news, and as things started to reopen and come back to life, people started to think, wow, things are coming back to life. But, we lost a couple of months of production in autos, in semis, in finished wood products derived from lumber, and that the flood of demand, particularly on the good side, because last year a lot of people bought cars because maybe they moved to the burbs. They bought a lot of laptops because they were working from home, or their kids were learning from home. They certainly bought their Pelotons, and there was a rush of spending on goods. The goods supply chain couldn't keep up, and we had this inflation. So people on the transitory side think, okay, well, supply chains are going to normalize and everything's going to go back to normal, and so on and so on. One of the key things, though, that has me in the non-temporary transitory camp is the whole just-in-time inventory world that we've been in for the last, 20, 30, 40 years, where on paper and in reality, it was very efficient. You had companies that, let's just take a home builder, for example. They weren't going to get delivery of the HVAC system or the washer and dryer until they exactly needed it, until the house was framed, until the wiring was in place. And once that was done, in comes those goods. Well, now, unfortunately, I think just-in-time is dead, and that companies are going to have to keep more inventory of these things because the flow of goods is not going to happen as smoothly, and companies can't take the risk of another, I don't want to say it's a pandemic, but any sort of supply disruption that sort of then clogs up the entire supply chain, because if the house can't get wired, well, then you can't put up the sheetrock, and if it can't get wired, as I said, you can't get the washer and dryer, and it clogs everything up. So you can multiply that across a wide array of industries, particularly autos. And I'll bring that up because when you think about the Michigan auto plant or the auto plant in South Carolina, they are getting hundreds of parts from all over the world. And if on assembly line there can't be any mistakes, there can't be any disruptions, and if there is, it clogs up that whole assembly line. And now we're seeing in particular a disruption, of course, in the production of semiconductors because the semiconductor industry wasn't ready for the flood of demand of pretty much a new sector of demand in autos. Plus, we've had 20 plus years since the tech bubble in the late 90s, where we've had essentially very little semi production in the U.S. that was then outsourced to elsewhere, particularly Samsung and Taiwan Semi, to name two big semiconductor companies. That all of a sudden, if just in time goes away, you've went 20 years of no investment or little investment in U.S. semiconductor production, and then all of a sudden you have a rush of semiconductor needs. Well, that just doesn't get solved in 6 to 12 months. That takes years to resettle itself. Now, at some point, maybe we'll have an oversupply of semis, but you get my point. And
let me ask you a question.
On here, but
it's actually, I didn't want to stop you because I think that it's very useful. And as you're going, it occurs to me how different your argument is from the argument of many others who might come to the same conclusion. There are certain political talking points right now about inflation, and I know that is not where you're coming from, that argue that in and of itself, this high level of government indebtedness and in and of itself, this Fed accommodation is creating the inflation. But what I'm hearing from you is much more nuanced. It gets into the complexity of supply chain issues, the distinction between goods and services, the possibility of stickiness on the services side that changes the data from what we've been used to. Those are not the arguments that I think most people on Fox News talking about inflation are making.
Well, the next part, I guess, of the inflation argument is to really the point you're exactly making is, I talked a lot about the supply side. Well, let's look at the demand side over the last 12 plus months. The amount of government transfer payments was so big that it offset and then some the lost income and wages from people losing their jobs or having reduced hours. So that kept the level of demand even greater than if we had no COVID. So the Milton Friedman basic definition of too much money chasing too few goods, it's exactly what we're seeing. We're seeing all that fiscal spending that is being partially financed by Fed's QE program that then meets these major supply disruptions, both in terms of product, raw materials, and labor. And it's essentially the perfect recipe for a bout of inflation.
Now, so at this point, let me, I don't want to say I'm playing devil's advocate because this kind of is my view. But I want to let you unpack your view rather than kind of argue about it. The velocity issue is something I've been unable to get past for a long time. I'm a Milton Friedmanite through and through. And I do believe that inflation is too much money chasing too few goods. But I'm also pretty sympathetic to Lacey Hunt's argument that Milton said that presupposing pretty constant velocity. And we have utterly collapsing velocity, even in this demand surge created artificially by transfer payments out of the COVID moment. And so I wonder if there's some vocabulary things going on. The perfect storm you talk about, I think your argument's indisputable. There are supply chain issues now. Whether or not just in time really is going to go away entirely or not, I guess that's up for discussion, but that's a good argument combined with your point of what has happened to M2 as a result of this surge of government spending. But then when you look to the need for loan demand and velocity on that money to create what we would traditionally think of as a more inflationary, secular inflationary period, that's the part I have a hard time with. And I wonder if you think those are two separate subjects, or do you just have a different point of view?
So I have huge respect for Lacey Hunt. I've been fortunate enough to hear him in person and giving, very thoughtful arguments. He's a brilliant guy. And what's interesting is inflation is always higher, persistently, for decades, decades upon decades upon decades. The only question is rate of change.
Right.
In the 80s and 90s, we still saw ever rising inflation.
Yeah.
It was just the rate of change that slowed, and into the 2000s, just the rate of change. But every single year, the cost of living goes higher, just a matter of to what degree.
That's
so
right.
You have an ever rising level of inflation, just to look over the last 10 years, but a collapse in velocity. So that collapse in velocity has not prevented persistent price increases. Only, again, the rate of change has mattered. The debt overhang is certainly a big question.
But Peter, I'm sorry to interrupt, but let me ask you just on that point, which is so important. For those who are arguing for a new structural inflationary regime, wouldn't you say that they're not merely arguing that there's going to be the 2% inflation that we've had since the so-called Great Moderation? They are arguing that there will be something more than that, right? And so there is, to your point, those that are not as concerned about inflation are not arguing for actual negative inflation. It's just a debate as to whether or not we get 2%-ish, or those that are kind of in a 1970s camp that we could see 5 or 6% inflation. That's not a small difference. It's the difference entirely around how someone may allocate their bond portfolio, their stock portfolio, everything they might think about the economic world. And so does this discussion come down to a difference of degree, or isn't there a kind of almost paradigmatic distinction between what someone saying the growth of inflation will be 2%-ish versus the growth of inflation will be more than that?
Well, I'll try to slice through a few of that. I brought up the point of a collapse in velocity does not stop a rise in general prices. I want to make that point. What we've seen, to your point earlier, that yes, we've seen a pretty sharp fall off in the demand for credit, particularly commercial industrial loans. I think part of that is somewhat a bifurcated sort of market where large companies that have access to the capital markets have been able to issue money left and right. And whether you're a high quality credit or you're low quality credit, the capital markets have provided enormous amount of capital. If you're a junk rated company and you can't sell a high yield bond, no problem. There'll be plenty of bank loans that you can issue or paper that can be then syndicated and sold. The smaller, medium-sized businesses, I think that banks are still somewhat strict with the lending standards. I mean, the stories that I know personally and have been involved in is even just getting a loan for a franchise where it was easy to get one pre-COVID for if you're a brand new franchisee, but even after having a unit, it's even more difficult to get the second one. So I think that has explained at least the C&I loan sort of discrepancy or lack thereof, lack of demand there. Mortgage demand has obviously been high because of the pickup in the housing market. Credit card demand has been muted because of a lot of fiscal government transfer payments that has made it less needful to take on credit card debt. And plus, part of that money is being used to pay down credit card debt. But this has not, and none of this has really stopped the upward trajectory of inflation. But to your other point about, yes, is this a debate about whether we're going to have 2% inflation or 3 or 4 or 5? Yes, I guess so. Because even the people in the transitory camp just think that we'll go back to 1.5% to 2% inflation, which is sort of what the Fed obviously wants, and they consider that a sweet spot. Now, I argue that we're not getting back there for the next couple of years, and that we have to get used to maybe something that's closer to 3.5, or even 4. And while that may not sound too crazy, The problem is that the level of global interest rates is still so low that even 3% inflation that is persistent can be a big problem. It's going to be a big problem for the Fed, because when you have the Fed funds rate at zero and you have a 10-year yield that is less than half that 3% rate of inflation, that becomes a problem. And also a 3% inflation becomes not just a Wall Street problem, but a Main Street problem. And I think we're beginning to see this inflation story being a mainstream problem. We saw in the Wall Street Journal over the weekend highlighting a family that is dealing with this higher cost of living. And housing prices that are going up 15% a year is a massive problem, both for the first-time home buyer and for the soon-to-be renter because they can't afford to buy a home. This is the type of inflation where people are calling their Congress people and saying, what is going on here? So look at Europe, for example, that has negative interest rates, not just short-term negative interest rates, but far out on the curve where even the Germans have 10-year yields below zero, where you have 3% in Europe with that kind of monetary policy, that kind of level of interest rates, that is a big problem. So I'm not looking for high inflation of 1970 type inflation. I'm looking for higher inflation. And higher inflation, when many are living paycheck to paycheck, when we have the debt levels to such an extreme that we do, and interest rates that are so low, and monetary policy that is so off to one side, that even 3% to 4% inflation will be a problem, both economically and for the markets and for monetary policy.
I say to clients a lot that while I don't have a huge fear of generational high inflation, I have a fear of something worse, which is status quo, because at 2% inflation, they're having your purchasing power every 36 years and no one cares. No one does anything about it. Where if you were to get persistent 4% inflation, not 1 or 2 quarters of used car prices being high, not our timber being totally inadequate to feed lumber needs for 3 months, 6 months, whatever anyone's outcome of what we've been going through in these 3 to 6 months, let's just pretend it all stops. And your argument is that it won't. And I think that you could very well be right. But my point is, pretend it stops. If you were to have 2% inflation, as we've kind of gotten accustomed to, and actually by PCE standards, even less than that, I know that there's a lot of controversy on how it's measured, but my point is it doesn't become a political animal. What you're describing becomes a political animal. And if in theory we got that level, I think it puts us in recession to break it. But I think their playbook on how to break it is very Volckerite and known, where I don't think the central bankers think they can do anything about the other side, the other problem, stagnation, deflation, Japan, that they feel that's what they're on planet Earth to avoid, is the depression, the great financial crisis, these types of events that are inherently deflationary and cyclical, that feed on themselves in a negative feedback loop as bank lending compresses. One of my problems with the argument of 3 or 4% inflation is that I think the politicians want it and that they haven't been able to create it. And so I worry that we're saying, no, they do have the playbook to go about doing it, because I think that what they would say is, yeah, you're exactly right. That's what we want to do. And we intend to do it. Where I think that there's a bigger fear that they don't really know what they're doing, that they're just throwing stuff against a wall. And I would be as critical as you, and maybe even more so, on a lot of what the Fed's doing. But I wonder if the M2 side, and then, of course, the overall price level issue is actually secondary to just the massive distortion in markets that is being created, the moral hazard, the lack of a defense mechanism by staying at the lower bound for a generation. Do you feel that that's a separate subject from the inflationary concerns that you have, or do you think it is all kind of molded together, Peter?
Well, I agree 100% of the massive distortions we have in the markets that really took another leg higher when Bernanke and Yellen took the Fed funds rate to zero and initiated all this QE. Now, granted, Greenspan had rates at 1%, which is not that far above, but that was only a couple of years. Bernanke and Yellen kept short-term rates at zero for 7 years. 6 years after the recession ended, they still had rates at zero. Yeah. But the inflation part becomes a key part of this, because what basically gave central banks around the world a license to embark on such aggressive monetary policy was a low level of inflation. And we know, obviously, there was a lot of criticism at Bernanke that, oh, well, this money printing and zero rates is going to cause all this inflation. It obviously didn't, because there was no impetus on the fiscal side. It was really just sort of a monetary gun that was shot that was not met with other things. But if the inflation debate and inflation stats start to change, and instead of 1.5 to 2, we're talking 2.5 to 3, 3.5 to 4, well, that sort of handcuffs central bank ability to do as they choose. Because one of the things that I thought was noteworthy about the markets this year was the treasury market in the first 3 months of this year. I mean, we entered the year with the 10-year yield at 90 basis points, the 5-year at 35 basis points. And within just 3 months, the 10-year basically doubled, and the 5-year went from 35 basis points to north of 90 basis points. And that is without any change in commentary from the Fed. Not one hint at changing QE, not one hint at raising interest rates. It was the bond market saying, you know what? I'm a bondholder. I don't want you to run this economy hot. I don't want above trend inflation, because I'm not going to sit here as a bondholder and accept basically nothing for that. So the bond market.
I have to jump in, because I think what you just said is true. The 10-year doubled. But what if I just said this sentence? We got a vaccine a year earlier than we thought, and instead of 90 basis points, the 10-year went to a whopping 180 for a minute. You know, both of those sentences are true, but they kind of sound very different. Like, one is more, let's price in a little bit of growth because the world's going to reopen, versus one saying the bondholders are demanding more because, you know, in response to the Fed. Like, I see anything in the 10-year below 300 basis points as the Fed being impotent.
Well, the Fed is clearly impotent, and not just that, they're actually causing a stagflationary type situation. Okay. That's the fallacy. Well, there are a bunch of fallacies with monetary policy. One is their desire to run things hot, because if you run things too hot, it eventually flames out, and therefore you become impotent. I mean, when you think about monetary policy, it's supposed to impact the interest rate sensitive parts of the economy. Well, housing is the most interest rate sensitive part of the U.S. economy, and the pace of housing is now slowing because the Fed ran it too hot. That you had issues with supply, both on new construction and existing homes, and the Fed had pedaled to the metal on trying to generate stronger demand, to the point where price increases were so extreme, supply shortages became so extreme, that the Fed policy is actually damaging the housing part of the economy. And I can go on about Fed policy hurting the economy. Forward guidance hurts the economy. Central bank orthodoxy is if we tell the world that we're going to keep rates low for a long period of time, that somehow is powerful stimulus. But in fact, it's the exact opposite. Because if you tell people that rates are going to stay low, there's no sense of urgency to react. There's no sense of urgency to do something today rather than wait to tomorrow. Because that's what monetary policy is supposed to do. It's supposed to pull forward economic behavior. Monetary policy doesn't grow the pie faster than it would grow ordinarily. It just shifts the timing of it. So now you're making a real Lacey Hunt argument, right? Well, yeah. I mean, just look at Japan. I mean, Japan tells you that forward guidance is a complete failure because it just defers activity. If monetary policy or interest rates were set by the market and rates went up and down more fluidly based on the supply and demand for money, well, then you wouldn't just sit and wait around. There would be more of a sense of urgency, and business activity would actually improve and increase under that type of scenario. By the way, this podcast doesn't happen without the really wonderful support of sponsors. And please
listen to this message from one of our very wonderful and appreciated sponsors here at Capital Record.
Are you investing in companies that put liberal politics ahead of profitability? It's called ESG investing. It's when CEOs and fund managers use your investments to advance their liberal agendas instead of being politically neutral and maximizing returns for you. That's why Second Vote Advisors was created. It's pretty simple. Second Vote Advisors believe that companies focused on profit are better for shareholders than companies focused on politics. Backed by years of research, Second Vote Advisors invest in companies that are politically neutral, focused on returns, and don't offend conservative values like free speech, Second Amendment rights, border security, and protecting life. Second Vote Advisors concentrates on profits, not someone else's politics. Second Vote Advisors puts you, the shareholder, first. Go to secondvoteadvisors.com. That's 2ndadvisors.com for more information about Second Vote Advisors.
Yeah, see, I think that I agree with you 100%. I think it's not just that the Fed policy is ineffective. To your point, it's not intended to be able to do this. And somewhere on the line, we have this dual mandate talk is so bizarre. I think it was ill-gotten to begin with. The notion of price stability and full employment may have been overly ambitious intrinsically, but the real third mandate now of trying to provide some benefit from the business relief from business cycle disruptions has transferred. And this I don't put at Bernanke's feet. I think this clearly started at Greenspan as a kind of boost to risk assets when they are troubled. Some of the late 1990s action of Greenspan cannot be interpreted any other way of trying to facilitate an aid to the stock market. And yet, one of the things I've said is when they talk about the Greenspan put, it's now kind of the Fed put. I don't think it's a Wall Street put. I think they believe it for Main Street, that right now, COVID happens, the great financial crisis happens, various disruptions. We had the little incident with China in 2015, early 16. It looks to me like a whole lot of people just turn and wonder, well, what's the Fed going to do? And the Fed's idea of we're here to smooth problems in the business cycle is the conversation nobody wants to have. That the Fed has taken on a role that they cannot possibly ever be expected to succeed in.
I agree with everything you're saying. There is no question that the level of asset prices became the driver of policy and the believed economic growth under Greenspan. And when you look at pre-COVID, the prior two recessions were driven by declines in asset prices. You know, historically, a recession is inventories build up, and you need to work down inventories, or you pull forward some activity because of extra spending. You have a little give back, and that was a normal business cycle. Because of Greenspan, we turned economic cycles into credit cycles, into asset price cycles. So it was the collapse in tech stocks that led to a collapse in capital spending that led to that recession. You had a collapse in asset prices of homes that led to the destruction of bank balance sheets that led to that recession. So we had two booms and busts within a 20-year time frame. And now we are in another sort of financial market boom. And I argue that negative interest rates and the level of global bond yields is the biggest bubble in the history of financial markets. And getting back to our inflation discussion, if there's one thing that would leak the air out of a bond bubble, it's a level of inflation that is persistently higher than it was previous. And whether a central bank responds to that or not, markets still might. I mean, if you get a persistent reading of 3% inflation in Germany, I'm not sure how long people will want to hold bunds with negative interest rates. If they think that inflation will come back down again, maybe they'll be a little bit more tolerant, because we know negative interest rate bonds are just the ultimate hot potato. So the question then is will central banks lose control of financial markets, which will then lead to the next recession if they do, via higher inflation, which then slows down consumer spending. After all, we are a consumer-dependent economy. If real wages fall because inflation's running too hot, that slows growth, that's stagflation. If interest rates rise because of that inflation, that hits asset markets and stocks fall and rates rise. Well, that obviously is going to have an impact on consumer spending and capital markets and so on and so on. So I've always argued that the next recession, obviously I didn't foresee COVID, but, the next recession will be mostly led by a decline in asset prices, just as it was the two previous to COVID.
So I think that in the course of saying like 9 out of 10 things that I agree with, you highlight the one issue that I think is the heart of the matter on the inflation subject, which is the interest rates, where I think it's on purpose. It's fair in the point you're making, but it is begging of the question, right? Your point is that if we get inflation, it's really problematic that the long bonds are so low, and how long will markets be willing to tolerate the 4% inflation with the zero bound, on the longer rates? But of course, the argument could be made, and this is my argument, that it's a chicken or egg issue. How long can we say that we have inflation if the 10-year is something below 2%? The global yields that you've spoken to make the point even more, but I don't mind just isolating it to the U.S. since that's mostly what we've been talking about. Are you open to the idea that if we never get these longer bond yield increases, that it therefore means we didn't have the inflation that you're worried about? Or do you think that will be that will avoid interest rates moving higher for some other reason?
Well, I think right now, the long end, and one of the reasons why it's come off its boil of March is, well, there are a couple of reasons, but if
please don't say short covering.
No. Well, I'm not. I think part of it was the market response function when the Fed was a touch less dovish at their meeting in mid-June.
Yeah.
The historical trade is to flatten the curve, buy the dollar, sell cyclicals, and buy growth stocks that'll grow in a slower growth economy. That was a very knee-jerk response, because if you look back, and I'll get to the point in a second, if you look back when QE was on, the yield curve always steepened. When QE was off, the yield curve always flattened. So I think this flattening is basically the market's getting ahead of the possibility of QE turning off over the next 6 to 12 months. Also, I think that there's this tug of war, too, on the long end, that people see the inflation. Yeah, there's a contingency that thinks, okay, it's just temporary. But there's also a contingency that's seeing the stagflationary type situation that I'm talking about now. And just to add some more flavor to that, an auto plant that shuts down for 2 weeks, that's 2 weeks of lost production because they can't get semis. That's a stagflationary situation. Mm-hmm. So, one day the 10-year yield may respond with higher yields because they're worried about higher inflation. But on the other hand, maybe yields fall because they see slower growth. And also, we have to keep in mind that not many people below the age of 65 were around in the 70s. They don't know what persistent inflation is. They just know an ever slowing rate of gain that wage growth can offset any inflation that we see. Right. So there is not a large constituency. In fact, there's only a few Lacey Hunts out there that were around in the late 70s that know what that environment is like. So it's very easy to say, oh yeah, inflation, it always goes away. It's never a problem.
Well, I would actually argue that for most Americans in the generation you're talking about, they think of inflation as a positive in this sense. To the extent that vacations and toys cost more, wages have gone up as well. And so particularly for upper middle class people, they kind of just think, oh, it's all good. And certainly stock portfolios going higher, that hasn't really ever been felt.
Inflation. They love the asset price inflation.
Well, that's where I was going, is that I believe, I've spent all this time saying how I have a more Lacey-ish view on the inflation deflation discussion, But I'm overwhelmingly concerned about inflation in housing, higher education, and healthcare. But I don't consider any of those to be in my Milton Friedman camp of monetary inflation. I think all three are government created, but all three are government created through price subsidies. And that Milton Friedman himself said it, that people like inflation when it's their house. I think that the price inflation in housing, which led to the financial crisis of '08, which is really almost a cultural phenomenon in our country, people's belief, particularly boomers, belief in a sort of eternally vertically escalating value in their home far and above the rate of inflation or the rate of wage inflation, I think is sick and not likely to end well. But I separate it categorically from the higher price level that you're discussing. But I think your point's a really important one. People haven't lived through persistent price inflation. And in the 1970s, what was the real turning point? It was gas lines. And so go ahead.
That's when it went Main Street.
Yeah, I think so. And I think that because most people saw a VCR in the 1980s go from $800 to now the most fancy technical digital equipment being, a fraction of that cost, that overall most people's experience in their lifestyle has been deflationary. Their asset prices have been inflationary, but the one idol they hang it all on is housing prices. And yet the government subsidies that have really driven the negative inflation, the negative aspect of inflation, healthcare and higher education. We don't seem to have the discussions around those areas. And I think that that's significantly more problematic. And even in the Great Moderation, you had 5.5%, 6% annualized inflation in college tuitions. Why do you think that topic doesn't get kind of included in this broader inflation subject?
Well, when you talk about subsidies, artificially low interest rates is a subsidy on a home. So the Fed is directly guilty of creating a lot of this home price inflation, and in so many ways, both in enticing people to buy a home because their mortgage rate.
But if the Fed had the Fed funds rate at 0%, and there was no such thing as Fannie or Freddie, that essentially has become the entire American mortgage market, it would be a very different subsidy. It would still be a subsidy, but it sure seems to me that the government's actual purchasing of the bonds is the biggest problem here.
Well, yeah, it would be, you would still see lower mortgage rates, but yes, not as low, because when you think about a mortgage-backed security, it is essentially a government piece of paper. So therefore, if it's a government piece of paper, its yield spread to a treasury, which is the ultimate government piece of paper, is very tight. If Fannie and Freddie were not there and it was the private market that was buying these bundled mortgages, well, then for sure, the private market would be demanding more yield. Therefore, you would have higher mortgage rates historically. But when you have interest rates that are still so low, yes, mortgage rates may be above where they are today, but the rate of change in mortgage rates would still be historically low. And while home prices, instead of going up 15% a year that we're seeing now, yeah, maybe they would go up less, but you would still see the same sort of yield grab type behavior that creates excesses and misallocations of capital and bubbles. So to me, you would still get that outcome. Maybe the degree again would be different if Fannie and Freddie weren't there. And again, private investors would expect more return on their investment, but you'd still see a lot of misallocations in that sector because the Fed would have sort of that base rate, that risk-free rate at a level where it never should be.
So at this point, given the things that have happened structurally in our system over the last 20 plus years and the various things that we're both concerned about, maybe with different prioritizations and some different perspectives, what do you think would be, if you were Fed chair tomorrow, Peter, what would you like to see that is practical and reasonable? A lot of times sound money advocates say things like, we got to go back to the gold standard tomorrow. And, you just think, okay, well, that's probably not going to happen. But what are practical things that could help to, even if we have to take some medicine, I'm not looking for a pain-free solution here, but what do you think is the best of all the bad options that are out there to, first of all, get us off this really malignant boom-bust cycle that we're on, and to just make for better markets and better allocation of capital that is right now being hampered by fiscal and monetary policy?
So taking medicine is really the key point, because there's really no way out of the current circumstance without taking medicine. I think one of the so if I was Fed chair, I would announce immediately that we're going to start to slow down the asset purchases. Okay, we are no longer doing QE. We are not only ending over the next 12 months the current QE, we are not doing QE again. Outside of open market purchases. It is not the Fed's purview to be buying mortgage-backed securities and treasuries to try to manipulate the Treasury yield curve, because number one, there's no empirical data that points to better economic growth. And in fact, when the Fed has done QE, rates have gone up instead of down. So that would go away. And I would talk about at some point next
Can I say something controversial about that? I don't agree with anyone who says that if they did that, markets would throw up. I think the algos would throw up for about an hour, and I think markets would be just fine in about 72 hours.
I think markets would be fine over 2 years, not 72 hours, because the Fed has brainwashed the markets into thinking that QE is good and that QE provides liquidity for the markets. And without that liquidity, markets, after QE1 ended, after QE2 ended, after QE3 ended, markets sold off. We know after the Fed has
but markets were up in 14, 15, 16, 17, and 19. The only down year was 18, and there was actual quantitative tightening going on that year. We were down a whopping 5%. But why do you think after QE3, markets kind of took it in stride after the taper tantrum? And there was some volatility, I acknowledge, but it wasn't what people seem to act like, as if equities are dependent on QE.
So every correction of note pre-COVID was around the end of QE and rate hikes. Yeah. So after QE1 ended, we fell 18%. I think after QE2, we fell about that. Obviously, we had the taper tantrum, but QE3 really didn't technically end until October 2014, and we had about a 10% correction. The Fed raised interest rates in December 2015, and we had a hissy fit in January, February of 2016. And then that scared Yellen. And instead of raising a few times a year, she raised not just one time in 2015, one time in 2016. Then,
after the election, she didn't raise for the full 12 months.
Right. So that's why we recovered from that correction. And then 2017, it was all about expectations of a corporate tax cut. And then eventually, so that's why we went up in 2017. But then by February 2018, we had, the vol trade blow up, and we had a sharp correction because the Fed at the same time was doing quantitative tightening, as you said. And then we got to a point where interest rate increases, broke the system at only 2.5% in the fourth quarter of 2018.
Yeah.
So that's
in the towel in 3 days.
That the market, the reason why we're trading at 23 times earnings is because of the psychological boost to markets via QE and rates being at zero. So I feel like, because when you think about the Fed put, a lot of it is psychological, because QE is really just an asset swap. It's here's some cash, give me your bond, but then you end up depositing that cash back with the Fed. A lot of that money doesn't necessarily leak into the markets. So the impetus of QE is very much psychological. So to the question of what I would do, so I would end QE, and then I would talk about we're going to start raising interest rates at some point by the end of this year or into next year. I'll go slow because I don't want to blow things up, but rates are going to go up, because I think one of the poisons going back to Greenspan and monetary policy is negative real rates. The market would never, or I should say never, would rarely set the level of interest rates below the level of inflation, because why would you price money that way? And it wasn't until central banks decided that was a good idea that we created a lot of these excesses and these imbalances. So I would basically tell the market that I would try to get the level of interest rates to at least zero on a real basis. And in a perfect world, at some point say, you know what, we're done with this. We are no longer going to be setting the price of money. We are leaving the overnight rate to the markets, and we will just be a lender of last resort and play that role and not think that we're that smart that we can set and decide what the right level of interest rates should be, which is essentially is price fixing. And if you were doing that in the private sector, you'd go to jail. But the Fed gets to do it, and they don't get to go to jail.
So to recap, a pretty realistic and sensible policy prescription that you would do would be to eliminate QE and to telegraph that QE wouldn't be coming back. And then secondly, it would be to get rates at at least zero level, a real rate, get nominal rates high enough on the overnight that the real rate would at least not be negative. And then third, which is obviously the probably least realistic of these, but would pass for policy in Peter and Dave land, would be to just use the Fed as a lender of last resort, not as the discount rate or Fed funds rate setter.
Correct.
Yeah. Pretty reasonable stuff, my friend.
Now, we know that getting back to the medicine portion, that this will be highly disruptive. It would lead to a resetting of valuations and PEAT multiples and economic activity. That's why realistically you would have to spread this out over a period of time. But that's the medicine that we would have to take if we want to get out of this trap that we're in, unfortunately. Which is amazing is that, there's one thing that a government bureaucrat does is when they try something and it doesn't work, they just do more of it. And if that doesn't work, they do even more of it. And we have Japan as a perfect example of how not to run monetary policy. But the Fed, the ECB, the Bank of England, Reserve Bank of Canada, the Bank of Canada, the Reserve Bank of Australia, they all decided to do exactly what the Japanese have done. And they all are expecting somehow a different result.
Do you think that we're going to end up, that our Fed will end up owning 60% of our bond market the way the Bank of Japan does?
Probably. I would obviously want to say I hope not, but probably, because they believe in QE. They think that is an economic stimulant, when the only thing it does is lift asset prices and monetizes debt, government debt.
We would have to have a massive recession. I mean, if you think about it, they did QE 1, 2, and 3, and then they did unlimited QE post-COVID, and they still don't even own 20% of our bond market. Which is one of the reasons I'm resistant to people when people say the 10-year is only at 135 because the Fed's intervention. I don't think that's totally true. The Fed has not been a big buyer of long-dated bonds. And when QE3 ended, they were buying no long-dated bonds, and we still stayed pretty low level. But you could get our Fed to be up to 60% because, as you say, they believe it works, but they would have to have some new catalyst to come, some new black swan event or something like that.
Yeah, well, I think that the U.S. 10-year 135 is more at that level because the German 10-year Bund is at minus 30 basis points, and more of what the ECB is doing, and directly what they've crushed their level of interest rates over there, and how that spills over into the U.S. That's why. Can you imagine what's going to happen to the global bond market if the ECB decides just to get rates back to zero, let alone positive, just back to zero, and how disruptive that will be to global bond markets? I mean, that's way down the road, but
maybe I can twist your arm into coming back another time. We can talk about that whole matter, because I know you have really well thought out opinions on global bond yields, and it's been helpful today that we've kept our conversation primarily within the U.S., but there's a whole conversation about Europe, Japan, currency wars, the whole race to the bottom subject that maybe we can unpack another time.
Yeah, absolutely. Would love to. Thanks so much, Dave.
I really appreciate you coming on, Peter. Thanks very much.
I appreciate it.
Well, I hope you enjoyed that conversation as much as I did. As you can see, Peter is very thoughtful economist. He makes his case with a lot of conviction and data. There is an awful lot he said today I agree with. The primary fundamental framework that both Peter and myself think from is one that is critical and concerned about distortions in the financial markets, even well-meaning ones, even from well-meaning people, and the overall belief that sometimes these things feed on themselves, and that Federal Reserve interventions in particular lead to more interventions, which lead to more interventions, and so forth. And I think that Peter's done an outstanding job highlighting what some of the misallocation of capital and some of the just broader concerns that we have about the present central banking regime, particularly around quantitative easing. I do think he, on a number of occasions in our talk, highlighted what I think is the heart of the matter for me, which is that those inflationary pressures he's worried about are not merely building while the bond market is eventually going to end up having this big revolt, but I believe the bond market not having its revolt is, until proven otherwise, indicative that those inflationary pressures are not building. So I think that there's this sort of chicken or egg thing there that we clearly disagree on. And yet, as you heard, his argument is not the same. He's making a much more nuanced argument around the current supply chain dynamics. His belief that just in time is obsolete. I'm not sure if I agree with that or not, but I think it's a fascinating thesis, and it's one we want to continue watching as to what more systemic changes in American manufacturing and American production of goods may entail. But I do believe very strongly that the long bond yields indicate more about inflationary pressures in financial markets than anything else. And so there's an interesting kind of sequence of how we're looking at that that might separate that part of Peter's view and my view. But nevertheless, I hope you appreciate the discussion. I think there was a lot of really good information Peter gave, and this is not a topic that is mutually exclusive. Like there's the good guys on one side, bad guys on the other. There's a whole bunch of bad guys that go out there saying stupid stuff. What we have here is a lot of good guys that are concerned about a threat to free enterprise, a threat to economic prosperity, a threat to economic stability, the exacerbation of boom and bust cycles. And within those shared concerns that stem from shared presuppositions about free enterprise and capital markets, there is room for disagreement as to how some of this stuff will play out. And I think that's a little bit of what we have here. We'll continue to have with other guests. We want big tent, but thoughtful considerations of all this that affects capital markets. It's what we are here on earth to do, to defend the cause of free enterprise, because we want to defend the cause of human flourishing. Thank you for listening to Capital Record. Please review us at your podcast player, give us stars, and do all the things that are necessary to articulate your enjoyment of this podcast. And with that said, thank you for listening to the Capital Record.